Hey everyone, welcome back to our channel. Today we're diving into a thrilling topic that's been on the minds of many aspiring investors. Investing in startups, 5 risks and rewards. Whether you're a seasoned investor or someone just dipping their toes into the world of startups, this video is packed with insights to help you make informed decisions. Alright, let's get started. So, why should you consider investing in startups? Well, the potential for high returns and the excitement of being part of a groundbreaking venture are just a couple of reasons. However, it's not all sunshine and rainbows. There are risks, and being aware of them is crucial for any investor. Let's explore 5 key risks and rewards associated with investing in startups. Number 1, high potential rewards. Firstly, let's delve into the enticing realm of rewards associated with investing in startups. The allure of this venture lies in the potential for remarkable returns, often exceeding those offered by conventional investment avenues. Startups, characterized by their innovative and dynamic nature, possess the capacity for explosive growth. As an early investor, you stand the chance to reap substantial financial gains, akin to the monumental success stories of early backers of companies like Amazon or Google. The prospect of investing in startups is akin to planting seeds in fertile soil and witnessing them burgeon into towering trees. These emerging companies often experience rapid and unparalleled expansion, leading to an exponential increase in their valuation. This trajectory, when coupled with astute investment timing, can result in financial windfalls that far surpass the gains achievable through more traditional investment channels. Consider the historical trajectory of giants like Amazon and Google, both of which began as humble startups. Early investors in these tech behemoths reaped extraordinary rewards as the companies grew into global powerhouses. Picture yourself in the shoes of those visionary individuals who recognized the potential of these nascent enterprises and became instrumental in their early stages of development. The allure of startup investment lies not only in the promise of substantial financial returns, but also in the thrill of being part of a journey marked by innovation and transformative growth. By becoming an early investor, you position yourself at the forefront of groundbreaking ideas, technological advancements, and the shaping of industries. The rewards extend beyond mere financial gains. They encompass the satisfaction of contributing to the success story of a burgeoning enterprise. In essence, the rewards associated with investing in startups transcend the conventional, offering a dynamic and potentially lucrative landscape for those who embrace the inherent risks and seize the opportunities presented by innovation and entrepreneurship. It's a chance to partake in the growth stories of tomorrow's industry leaders and, in doing so, potentially realize astronomical rewards that could reshape your financial landscape. Number 2, risk of failure. Now, let's turn our attention to a critical aspect of startup investment: the unavoidable reality of risk and the potential for failure. It's essential to acknowledge that startups inherently carry a significant level of risk and, unfortunately, many do not succeed. As an investor, there exists a genuine possibility that the startup you choose may not navigate the complex terrain and may face challenges leading to failure. Embracing the truth about the precarious nature of startups is a vital step in developing a well-rounded perspective on investment. The business landscape is dynamic, and factors beyond anyone's control can influence the fate of a startup. Therefore, it becomes imperative for investors to adopt a strategy that mitigates risk and cushions potential losses. Diversification emerges as a key strategy in navigating the uncertainties associated with startup investing. By spreading your investments across multiple startups, you reduce the impact of a potential failure of any single venture on your overall portfolio. This approach helps cushion the blow of setbacks, increasing the likelihood that successful investments will offset any losses incurred. Being mentally prepared for the possibility of losing your investment is a crucial mindset for a startup investor. It's akin to understanding that not every seed planted will grow into a flourishing tree. While the allure of success stories is compelling, acknowledging and preparing for the flip side of the coin, the risk of failure, is indispensable. Maintaining a balanced approach to startup investing involves a realistic evaluation of the potential downsides. Investors need to weigh the thrill of potential success against the sobering reality of potential failure. This pragmatic approach ensures that decisions are made with a clear understanding of the associated risks and rewards, preventing undue emotional reactions in the face of uncertainties. In essence, recognizing and addressing the elephant in the room, the inherent risk of failure in startups, is fundamental for any investor. It's about acknowledging the unpredictable nature of the business landscape, preparing for setbacks, and strategically diversifying to enhance the resilience of your investment portfolio. By doing so, you position yourself as a savvy investor capable of navigating the unpredictable journey of startup investments with a measured and informed perspective. Number 3. Illiquid investments. An aspect frequently underestimated in startup investments is the issue of liquidity. Unlike publicly traded stocks, divesting your stake in a startup poses considerable challenges. Numerous startups require several years to either go public or be acquired, resulting in a prolonged period during which your capital is tied up. The lack of immediate liquidity in startup investments is a notable drawback, especially for those lacking patience or seeking more readily tradable assets. This unique characteristic of illiquidity in startup investments demands careful consideration. In the stock market, selling shares can be executed swiftly, allowing investors to respond promptly to market changes or capitalize on emerging opportunities. However, the startup landscape operates on a different timeline. Investments may be locked in for an extended duration, and the process of converting equity into cash can be protracted. For investors accustomed to the agility of traditional markets, adapting to the slower pace of liquidity in startup ventures is essential. The potential delay in accessing returns poses a challenge, requiring a shift in mindset and strategic planning. This illiquidity factor underscores the importance of aligning your investment horizon with the unique dynamics of startup ventures, emphasizing the need for a patient and long-term perspective. While the lack of liquidity is a distinctive characteristic of startup investments, it is crucial to recognize that this aspect is not inherently negative. Rather, it emphasizes the necessity for investors to align their expectations and strategies with the specific nature of the startup ecosystem. Despite the challenges posed by delayed liquidity, the potential for substantial returns and involvement in groundbreaking enterprises remains a compelling draw for those willing to navigate the distinctive landscape of startup investments. Number 4. Hands-on. Involvement. Another crucial consideration in the realm of startup investments is the degree of involvement you desire in managing your portfolio. Investors typically fall into two categories: those who prefer a more passive, hands-off approach, and those who relish actively contributing to the development of the startups they back. It's paramount to evaluate your comfort level and the amount of time you can allocate before immersing yourself in the dynamic world of startup ventures. For investors leaning towards a hands-off strategy, the appeal lies in a more laid-back role. This approach involves entrusting the day-to-day operations and strategic decisions to the capable hands of the startup's management team. The investor's primary role is that of an observer, awaiting the fruition of their investment with minimal active involvement. This approach is particularly suitable for individuals with limited time or those who prefer a less intensive commitment. Conversely, an active involvement strategy attracts investors who relish being hands-on contributors to the startups they support. This engagement may encompass offering strategic advice, leveraging industry connections, or participating in decision-making processes. The satisfaction derived from actively shaping the trajectory of a burgeoning business becomes a key driver for investors who opt for this immersive approach. Assessing your own preferences and constraints is essential before delving into the startup ecosystem. Consider your comfort with risk, available time commitment, and whether you lean towards a more passive or active role. Striking a balance between your investment goals and the level of engagement you seek ensures a harmonious and fulfilling experience in the dynamic and evolving landscape of startup investments. Number 5. Regulatory and market risks. The final piece of the puzzle in the world of startup investments involves delving into regulatory and market risks. These external factors wield substantial influence, capable of shaping the fate of startups. Keeping a vigilant eye on industry dynamics, Understanding regulatory frameworks and being attuned to market shifts are indispensable aspects for making well-informed investment decisions in the startup arena. Regulatory risks refer to the potential challenges that arise from changes in laws or policies governing specific industries. Startups often operate in sectors characterized by rapid innovation, and regulatory frameworks may struggle to keep pace. An alteration in regulations can affect market entry, product development, and overall business strategies. Hence, investors need to stay abreast of potential regulatory changes that might impact the startups they are eyeing. Similarly, market risks are inherent in the ever-evolving business landscape. Shifts in consumer preferences, technological advancements, or economic downturns can significantly impact the success or failure of startups. For instance, a sudden surge in a competing technology or a change in consumer behavior can alter the market dynamics, affecting the valuation and growth trajectory of startups. Understanding these market dynamics is pivotal for investors seeking to navigate the unpredictable currents of startup investments. Remaining informed is the linchpin in mitigating regulatory and market risks. Regularly monitoring industry trends, staying abreast of regulatory developments, and conducting thorough market analyses are essential steps. Investors need to cultivate a proactive approach, anticipating potential challenges and adapting their strategies accordingly. The startup landscape, with its inherent dynamism, demands a level of adaptability from investors. Recognizing that external forces, whether regulatory changes or market shifts, can significantly impact the startups in your portfolio is crucial. It underscores the importance of not only being a passive observer, but an active participant in the ongoing narrative of the industries in which your startups operate. In conclusion, the multifaceted nature of startup investments necessitates a comprehensive understanding of regulatory and market risks. Staying informed and agile in response to external factors is paramount for investors navigating the intricate web of startup dynamics. By incorporating these considerations into your investment strategy, you equip yourself to make prudent decisions in the face of regulatory changes and market fluctuations, ensuring a more resilient and rewarding journey in the world of startup investments. And there you have it. Investing in startups comes with its fair share of risks and rewards. From the potential for high returns to the risk of failure, being an informed investor is key to navigating the startup landscape successfully. If you enjoyed this video, give it a thumbs up and let us know in the comments if you've ever considered investing in startups. Don't forget to subscribe for more insightful content, and until next time, happy investing. Thanks for joining us today. Stay tuned for more exciting content, and we'll see you in the next video.